Is the U.S. economy on the brink of collapse? And how can you prepare? Introduction. The discourse surrounding the strength of the U.S. economy in 2024 and beyond is met with skepticism as major red flags are identified. This analysis highlights three key economic factors that could converge in 2024 and 2025. The impending credit crunch resulting from the pandemic-induced debt surge, the delayed impact of higher interest rates on unemployment, and the cost of living dilemma characterized by persistent inflation and falling wages. The credit crunch, corporate and commercial real estate implications, the aftermath of the pandemic witnessed corporations accumulating significant debt. The reason being that in 2020, 2021, and the first half of 2022, the interest rates were at an all-time low. Corporations had their once-in-a-million chance to borrow millions and billions at just the interest rate of 4% per annum. However, a crucial concern emerges as these corporations face debt readjustments in 2024 and 2025. The potential for sustained high interest rates could lead to a surge in debt payments, impacting corporate expenses and profitability. Commercial landlords, especially those in the office space sector, face a unique dilemma. With many offices experiencing significant vacancies due to changing work dynamics, landlords find it challenging to pass increased costs onto tenants through higher rents, potentially resulting in financial strain. Mitigation efforts, government intervention, and commercial real estate transformation. Recognizing the impending challenges for commercial landlords, the White House has introduced measures to mitigate potential bankruptcies. A multi-billion-dollar program allows office owners to convert commercial spaces into residential units, offering subsidized mortgages and grants. This initiative aims to stabilize the commercial real estate sector and prevent widespread defaults. Credit crunch and banks, risks and implications. The credit crunch extends beyond corporations and landlords to impact banks. Earlier instances of bank failures, exemplified by Silicon Valley Bank, were attributed to sitting on underwater assets, particularly treasury bonds. As interest rates rise, bond prices fall, putting banks at risk. The issue persists, with ongoing increases in interest rates potentially exacerbating the challenges faced by banks. If banks experience financial strain due to a lack of incoming payments, the inability to raise more funds while holding underwater assets could lead to further complications in the banking sector. Impacts of higher interest rates on employment. The Federal Reserve's strategy of raising interest rates to combat inflation has cascading effects on employment. As interest rates increase, spending becomes more expensive, curbing consumer demand and affecting businesses. This results in a slowdown in hiring and wage growth. The job market, once favorable to employees, is now shifting in favor of employers as downsizing becomes prevalent. The trend of slowing employment growth and wage stagnation is expected to continue into 2024 if interest rates remain high. Inflation and its compounding impact. While discussions on inflation cooling down are prevalent, it's crucial to understand its compounding nature. Inflation continues to rise, albeit at a slower pace. The cumulative effect of years of above-average inflation compounds the financial burden on individuals as wages fail to keep up with the rising costs of goods and services. The slowdown in spending, exacerbated by factors like the restart of student loan payments, contributes to a potential increase in unemployment, further dampening economic growth. Strategies for mitigation and financial preparedness. As the economic landscape presents challenges, a proactive approach to financial education and preparedness is recommended. Individuals are advised to be cognizant of the red flags in the economy, understand the multifaceted nature of economic challenges, and capitalize on opportunities that arise. While the current economic scenario allows for growth and spending, the importance of building financial literacy and preparedness is emphasized. Rather than indulging in excessive spending, the focus should shift towards understanding the intricacies of the economic puzzle and positioning oneself to navigate potential challenges. Conclusion. The intricate web of economic challenges, including the looming credit crunch, the impact of higher interest rates on various sectors, and the persistent inflationary pressures, necessitates a nuanced understanding of the economic landscape. While acknowledging existing opportunities, individuals are urged to prioritize financial education and preparedness to navigate potential pitfalls. As the U.S. economy enters a critical phase in 2024 and 2025, a well-informed and proactive approach becomes paramount for both individuals and businesses alike. Call to action. Feel free to share your interests in the comments, and we'll make sure to include them in our upcoming videos. Don't forget to subscribe for more insightful content. Don't forget to like, subscribe, and share.